I've spent the last year as the treasurer of IMCA, and not only as an advisor with UBS, but working on how to manage the assets that we have within our own endowment. As I came out of several meetings today, what I noticed was a tremendous level of emphasis on what's going on in the world of interest rates and a way to take advantage of them. And we listened to a gentleman from JP Morgan today talk about some of the areas that are most concerning. If you take a look at the spreads today, probably one of the first bullet points is I want to make sure that any area that I'm focusing on for fixed income from our portfolios is really taking a look at, is there value still left, or is it just the story? And in that space, I know there are 2 or 3 specific areas that I want to take a look at as to how much I have and maybe trim that back, potentially in high yields and convertibles. Second, as we take a look at duration management these days, the correlation between the several different asset classes are an area that I have to evaluate, because where I thought I've been very diversified in fixed income, what I'm finding is I've got correlation levels that are so close, I will get hit hard if I don't evaluate those in the middle of a rising interest rate environment. And third, as we've seen a tremendous level of rise in the level of the use of alternatives, maybe as a bond replacement over the course of the last number of years for foundations and endowment, we've gone over a short period of time from about 3% to over 38% of the use of alternatives. I need to be speaking more about this area of this asset class with my clients. We heard from one of the largest asset managers in the world today in Wilshire Associates, and we walked through their evaluation process for looking at liquid alternatives as a measure of bond risk replacement in a portfolio, and I can imagine having that conversation with practically all my clients over the course of the next several weeks. I'm glad I pulled that out of the IMCA conference today.